Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. First of all, an apology for the lack of podcast last week. This was due to illness on my part, and while I'm still not 100%, we've still got plenty to talk about this week. I'm Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown, fresh from another ECB press conference and listening to Christine Lagarde. So, did she have much to say, Michael?
Well, very good afternoon, Matt. I'm glad you're on the mend. And the short answer to that question is no, absolutely not. Even by the ECB's pitifully low standards, it was an incredibly dull and tedious affair this afternoon. I think very much a case of the ECB not wanting to rock the boat before they all go off on their 8-week-long summer holiday.
But no changes to monetary policy, pretty much steady as she goes.
Absolutely.
Okay, well, since we last spoke, the FTSE 100 has finally pushed above 9,000. So we're going to talk a little bit about that. And of course, that's brought about the inevitable consequence that we're now getting speculation of a move towards another big round number, 10,000. Jackson Wong on the Good Money Guide has talked about that. And there's an article that you can find detailing his reasoning for another 12% move higher. I mean, we've seen a 12% move higher already this year. I think another 12% is stretching it a bit, but there's no reason to suppose we can't get there at some point. But it's not just the FTSE 100. We've seen US markets kicking in again with new record highs. The S&P 500, the Nasdaq, the Nikkei 225.
Mm-hmm.
So far so good. And European markets may well get in on the act, but they're lagging a little bit. And I think that's probably due to uncertainty about whether or not the EU and the US will come to some form of deal. But anyway, before we get into all of that, it's risk warning time. So here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 73.7% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So, topics, Michael. We've got a lot to get through. Obviously,
We do. I have an incredibly long list in front of me of talking points this week.
Yes, indeed. So, let's obviously outline them first, so that if people want to skip ahead, they can. But if they don't, this is what we're going to be going through. So first and foremost, we've touched upon it a little bit. What's driving markets this week? So obviously the trade deals, anti-coercion instruments, whatever that is. Number two, obviously the Trump-Powell dynamic continues to generate headlines, though I think bond markets are largely ignoring the noise. ECB left rates unchanged. We've talked about that. We can probably skip over that. Is it an arbiter of what to expect at next week's Fed meeting? Again, we'll get into that. We'll look back very quickly, at the earnings that we missed last week in my absence. Well, EasyJet, JP Morgan and Netflix, and what they tell us about the underlying UK and US economy. We'll look at the UK economy and obviously the data that we've seen this week, and it doesn't paint a pretty picture. And we'll also have a brief look at this week's numbers from Lloyds, Vodafone, ITV, Reckitt Benckiser, Wizz Air, Tesla, Alphabet, before looking ahead to next week's Fed meeting and lots more earnings from Barclays, Shells, Rolls-Royce, Apple, Amazon, and Microsoft. I mean, it's difficult to keep up, isn't it, Michael?
It really is, mate. There is so much going on. I mean, earnings season is always busy enough as it is before you pile on top all of the trade deals that are going on or perhaps not going on, depending on what you believe. And then you've got, these daily attacks from the Trump administration towards the Fed, not just Chair Powell, but the entire board. It really is a struggle to, sort of keep up with everything that's going on. But at the same time, I think the way in which the market is still showing a remarkable degree of resilience, as you mentioned, in terms of those record highs that we're seeing in a number of developed market equity indices. For now, the view among market participants is, there's a lot of noise out there, but fundamentally, the economy globally remains pretty resilient. the direction of travel is towards trade deals being done, and investors are pretty happy to load up on risk as a result.
But don't you find it counterintuitive, Michael, when you're talking about 15% tariffs being, I mean, obviously that's above the 10% that we've got here in the UK, and yet markets appear to be fairly happy with that. Again, we've got the Nikkei at record highs, we've got the FTSE 100, we've got the DAX again within touching distance, and US markets. What's it going to take to undermine sentiment here? Because ultimately, I don't see anything, and even bond markets now
Mm.
are appearing to be fairly sanguine about the prospect of the increased rhetoric that we're getting from Trump towards Powell.
Mm. Yeah, I completely agree with you. I mean, I think and I was talking about this on a number of client calls throughout the week. I think if you'd have sat here, 6 months ago and gone in, by the time we get to July, the EU and Japan are both going to be paying, subject to, I should say, a 15% tariff on the goods that they send to the United States. I think we'd have all gone, well, that's a little bit punchy. We'd expect the market to be considerably lower, but you've got to compare that against the alternative situation at the moment, which, if you believe the threats that Trump put in his letters at the start of the month, would be a 30% tariff on the EU and a 25% tariff on Japan. So it's not sort of organically, if you look at it on its own, you'd go, this isn't an amazing deal, but it's much better than the threat that was there. And when these deals get struck, it allows participants to price out that sort of no deal tail risk, for want of a better word. But I'm very much in the same boat as you. I sort of struggle to see a reason. That's not to say we won't see a little bit of downside. If we see some of the earnings numbers next week come in a little bit soft, then that could trigger a bit of near-term pressure. But I think fundamentally, I struggle to see a case for a prolonged decline in the equity market from here. Everything looks very, very rosy indeed, to be honest. And if we do get a couple of cuts from the Fed later this year, then that'll be a little bit of extra juice in the tank.
Just not one next week, perhaps.
No, I think the chances of one next week are very, very remote indeed, although it probably won't be a unanimous decision, which I'm sure we'll get onto later.
Well, let's talk about that a little bit, because I think President Trump is going to visit the Fed today.
Mm.
The new renovations, which he's trying to, I think, those renovation costs have overrun. He's perhaps looking for an excuse to fire Jay Powell. I really don't understand the urgency, given that he's going to be gone in May. But we've got eminent economists breaking ranks. Mohammed Al-Arian, who's quite a well-respected voice and has been for some years in the financial community, and I've got a lot of time for, but I've got to say, on this, he's way off beam. He's saying that Powell should leave in order to preserve the independence of the Fed. How the hell does that work?
Yeah, I think we are both in agreement here, and I think a lot of other folk on the sell side that I've spoken to, certainly over the last few days, are in agreement as well, that this is complete and utter nonsense, to put it politely, from Mohammed El-Arian. I think actually, and let me stress, the chances of this happening are very, very slim indeed in my mind. But if Chair Powell were to resign, far from preserving the independence of the Fed, it would actually serve to erode it much more quickly, because it would essentially set a precedent not just for President Trump, but for future presidents in the decades to come, that if you bully the Fed chair enough, they will eventually throw in the towel and you will get your own way when it comes to interest rates. And that is simply a precedent that should not be set. And I think Chair Powell has been very, very resolute in his desire and his plan to see out his term as chair, which of course ends next May. The other question, of course, is does he stay as a governor beyond next May? His term as a governor doesn't expire until January of 2028, and there's absolutely nothing legally that would stop Powell from staying on the board, even if he is not renominated as chair when that position becomes vacant. So I think El-Arian is indeed very, very far wide of the mark on this one, although it doesn't appear that these calls for lower interest rates and for Powell's ousting are going to slow down or cease anytime soon, sadly.
And I think the opposite will happen for interest rates if Powell is ousted. They won't go down, they'll go up.
Well, certainly long end rates will. I mean, we
Yeah.
had that sort of debacle last week while you were recovering, of course, where there were
Mm.
quite strong rumours doing the rounds that Trump was considering firing Jay Powell. I mean, he did a U-turn on that about 90 minutes later. But even in that 90-minute window, we saw a really big twist steepening of the yield curve. And actually, what we saw was, although the front end yields came lower, yields on the 30-year Treasury actually shot higher to about 5.05 or 5.1%. And if you were to see Powell leave his post, then those moves would obviously pan out many orders of magnitude larger than what we saw among those rumours. So I'm very much with you on that one. I think not only is it well, certainly not possible for Trump to be firing Powell. I also think doing so would actually achieve the complete opposite result of what Trump is seeking to do. He's trying to lower the interest that the US pays on its national debt. Well, sending long end treasury yields 100 points higher, that's going to increase the
Mm.
interest that you're paying on that debt. So hopefully someone in the some intern in the White House economic team can explain that to him. But I would not want to have that job.
I don't somehow think an intern will be having the president's ear. I think if anyone's got the president's ear, it'll be some Mr. Besant.
Well,
And I
he
think he's
was
probably the
reportedly
best
the
arbiter.
yeah, and he was of course reportedly the one who talked him out of it last time
Yeah.
out. So
Well,
yeah, I think Besant is very
the
much the one in touch with markets on all of this.
the adult in the room, perhaps.
Indeed.
Okay, I'm going to skip over the ECB because there's not really much to say there. Um, Obviously, while I was away, we had JP Morgan and Netflix results. Fairly decent, Michael.
Yeah, indeed. I mean, I think just more broadly, it's been a relatively strong start to earnings season. Obviously, the bank's doing particularly well in terms of trading revenues, as you would expect, given the huge market volatility that we saw at the start of April around all of the Liberation Day shenanigans. But by and large, I know Tesla disappointed last night, which I'm sure we'll come on to momentarily. But by and large, companies have actually reported pretty decent results thus far, which again is helping to underpin that positive sentiment that we were alluding to earlier on.
Yeah, I mean, JP Morgan revenue of $45.7 billion. Profits fell, but I think that was largely as a consequence of offloading a stake in Visa last year, which
Hmm.
boosted their profits last year. But overall, there was an improvement in fixed income, as well as equities trading, and investment banking fees also rose, which um, is actually quite positive. And moving on to Netflix, again, a strong set of numbers for the streaming giant. And it is the giant. It's
Hmm.
obviously the number one company in streaming. And their margins, again, continue to get bigger. Um, I don't think there's anything. And they raised their guidance as well. They raised
Yeah.
their revenue outlook for the year. So all positive. But as you say, the elephant in the room, Tesla. And
Yes.
yet, where are we with that? I mean, Tesla's results were the Q1 results were bad.
Hmm.
These ones weren't much better.
No, I think I've never been particularly optimistic around Tesla. I think there's clearly a lot of speculative interest in the stock. But as you say, the Q1 figures were pretty ropey. The numbers that we had last night, missing on revenues, missing on profitability. Margins were a little bit better, yes,
Mm.
fine. But the real worry, I think, is free cash flow, which was worryingly below street estimates. And then, of course, you've got Musk on the earnings call saying that we're in for a very rough few quarters ahead as the market adjusts to the removal of the EV tax credits in the one big beautiful bill that's now been passed.
Mm.
Things do appear, and obviously Tesla have had a pretty rough ride already this year. Things appear like they could get rougher over the remaining 6 months of the year. I struggle to see much reason for optimism on that front, in all honesty.
Yeah, I mean, the main drags on revenue were lower deliveries as well as lower selling prices. Now, I
Mm,
can't imagine that's going to improve. And while production levels are high, inventory supply is rising because essentially they're building more cars than they're selling.
yeah.
And that was, I think, one notable takeaway that I took from the Q2 numbers last night was that inventory levels were up from 18 days a year ago to 24
Mm.
days. So that's quite a sizable increase in inventory. On the flip side of that, pretty good set of numbers from Alphabet.
Yeah, they were a really good set of numbers from Alphabet. Although the one thing that the market did sort of struggle to digest last night, we had top and bottom line beats from Google or Alphabet, however you want to call them, but they did
Mm.
raise their capex guidance by about $10 billion, which they can clearly afford to do because those results were very very strong indeed. But the market took a little bit of a dim view of that, and the post earnings rally that we saw did fizzle out a little bit before picking up some steam as today has got underway. What I thought was interesting on that front was the read across that we can see into other companies, for example, Nvidia and Broadcom and some of the other chip makers, where it's clear that there is absolutely no slowing down in this sort of AI arms race. That's just going from strength to strength. So when you think about the order books for companies in the semiconductor sector, things are looking very, very rosy indeed there. And it will be interesting, just to jump ahead a little bit, to see whether companies like Meta and Microsoft and Amazon, who report next week, whether
Mm.
they also guide towards higher capital expenditures as everyone sort of competes to be number one in the artificial intelligence space at the moment.
Yeah, I mean the, the AI capex guidance was $75 billion in February. It's now $85 billion.
Mm,
What I was particularly struck by in Google's numbers, Alphabet's numbers, was the big jump in cloud revenue. It rose over 30% to $13.62 billion.
yeah.
So, what does that say about Amazon's numbers next week and Microsoft numbers next week? Because obviously they have a very big cloud component, Amazon Web Services, and obviously Microsoft with its Azure
Mm,
business. I think that could be fuel potentially for further gains, because you're spending all this money on AI. There's clearly some sort of objective there, an objective on a return
mm,
on the capital employed to spend that type of money,
yeah.
which rather calls into question the concerns over DeepSeek that we saw earlier this year.
Yeah, very much so. And I think one of the things that market participants are starting to pay a little bit more attention to, and probably will even more so as time progresses, is when there is going to be a return on this capital expenditure. And as you say, it seems as if that return is starting to bear fruit already. The one other thing I would say, just to take perhaps a slightly more glass half empty approach, is that if we were to see softness in those figures from any of the other Magnificent Seven names who report next week, then I think the market is going to take a very, very dim view of that indeed, particularly now that Alphabet have set the bar relatively high. It was already pretty high. Alphabet have probably nudged that a little bit higher still.
Mm.
If we were to get any sort of pessimism in the commentary around those figures from some of the other tech names next week, then you would imagine that the market would seek to punish that relatively severely.
You would think so. I mean, I'm looking at my charts for the Magnificent Seven, and obviously Tesla's disappointed, Alphabet hasn't. Only one other company apart from Nvidia has made new record highs, even though the S&P 500 and the Nasdaq are making new records. Only one other company has made new record highs. Apple hasn't,
Mm.
Amazon hasn't, Alphabet hasn't, Microsoft has.
Yeah.
So that's interesting.
Yeah, that's very interesting. I mean, of course, again, to take my pessimistic hat off and put an optimistic one on, maybe there is room for upside in a number of those names if we get positive
Mm.
updates next week, and that could be enough to sort of kickstart the next leg of the bull market
I mean, Microsoft has really outperformed its peers
massively.
relative massively, which suggests to me there's an awful lot of good news priced into that. Probably less so in the case of Amazon and the other Magnificent Seven stocks. Obviously, Nvidia is um, again another exception to that particular rule, because
Yeah.
obviously that's continued to make new record highs.
And of course, we don't hear from Nvidia in terms of their latest quarterly update until the very back end of August. So we've got a little bit of time to wait on that one.
Yeah, you might have to wait a long time for that, because I'm due to go away to the US at the back end of August.
Well, that's all right.
So
Let me give Jensen a quick bell. I've got him on speed dial. I'll ask him to move the reporting date for you, mate.
bring it forward. Bring it forward so we can chat about it. That would be
I'll
nice.
I'll see what I can do.
Anyway, so I mean, obviously that's the earnings picture. Before we move on to UK earnings, because there's been a lot this week, let's talk about the economy. Borrowing figures. Oh, I mean, is the UK economy circling the drain?
Well, I would say we're probably going down the drain rather rapidly at this moment in time, to be completely honest with you. I mean, if you just think about the last 2 weeks while we've been away, this week we've had a record high monthly borrowing figure for June in terms of the deficit when you take out the COVID period, which was obviously massively
Mm,
distorted. The week before, you had CPI rising to its highest level since January of last year. You also had core and services CPI coming in hotter than expected as well. You had another rise in unemployment to 4.7%, which is a high since the middle of 2021. And of
5. Yeah.
course, you then had HMRC PAYE payroll employment that fell for the eighth month in a row. Frankly, there really doesn't seem to be any sort of good news out there in terms of the UK economy at the moment. It's very much a case of, from a fiscal perspective, we are still stuck between, well, Rachel Reeves is still stuck between a rock and a hard place of a very unforgiving gilt market on one side and a bunch of backbench Labour MPs on the other who will not vote for the spending cuts necessary to balance the books. So that fiscal doom loop continues. And in the meantime, the economy continues to lose momentum. We had some relatively poor PMI numbers out this morning, and inflation remains stubborn, which prevents the Bank of England from loosening policy as much as they may want to. Um, Frankly, I don't see much cause for optimism, and I certainly don't see anything by way of an easy exit from this current situation.
I think we'll probably still see a rate cut in August, though.
I think we will. I think that's pretty much nailed on. I think what we won't see is any sort of overt dovish pivot from the
Mm.
BOE. Whereas we had been sort of talking about the possibility that they may, if assuming inflationary pressures were contained, we may see them begin to focus a little bit more on the labour market. Well, frankly, inflation is the backdrop there is not going to allow them to do that. So they will lower bank rate by 25 basis points in a fortnight's time, but I certainly don't think they'll do anything in terms of modifying that gradual and careful guidance that we've become very, very familiar with.
Mm. Well, we've certainly become used to low valuations when it comes to the FTSE 100, and maybe that's one of the reasons why we're doing so well, I think. I mean, obviously, as I look at the FTSE 100 now, it's at 9,140.
Mm,
Had a very strong session. And looking at this week's earnings announcements and recent ones, obviously we had EasyJet a couple of weeks ago. Um, that wasn't a particularly bad set of numbers, but the market took fright a little bit because of the fact they took a £25 million hit as a consequence of higher costs due to French air traffic control strikes, which cost it £15 million, and 10 million in higher fuel costs. It hasn't really recovered from that, but it still recorded record headline profit. So people are still spending money on budget airlines. Wizz Air's results this morning, Q1 revenue miss, unsurprising given its fleet problems. Haven't really seen much of a reaction to that, but again, that's pretty much in the price.
mm.
Um, the budget airlines don't appear to be doing that badly, so people still have money to spend when it
Yeah,
comes to going on holiday.
Yeah, absolutely. I mean, one of the things that we discussed, 2 weeks ago now it would have been, was the timing by which, when are people actually booking those holidays, and how you can extrapolate from that a read on the confidence that people have in their future financial situation. And I suppose there's a similar argument around the budget airlines. If they're doing well, then our people, we would need to compare their results against some of the legacy carriers, I suppose, to again try and gauge a degree or a view on confidence on that front. But it is a bit of a perplexing one, because you sort of look at the economy, and you go, the hard data that we just ran through, and you go, well, things are looking pretty dicey and pretty ropey. But then, as you say, the corporate reports that we're getting are satisfactory. If you wander around just anecdotally, sort of walking around both the city of London and southeast London, everywhere's still relatively busy. It doesn't feel like there's a significant pullback from the consumer. But then I would also say, if the labour market continues to weaken at the pace that it is at the moment, it almost feels like a question of when rather than if that pullback in spending actually does take place.
I mean, we've had Vodafone report today, we've had BT Group report today, we've had Reckitt Benckiser report today, Lloyds Banking Group, ITV. We've seen some pretty decent gains. ITV's up 12.5%.
Mm.
Reckitt Benckiser was up 9.8%. BT Group is up 10.4%. And then you've got Lloyds, which has originally dropped sharply, has now wiped out those losses and is trading more or less flat on the day. So let's break these down. Vodafone. We've talked about Vodafone quite a bit, I think, over the course of the past few months. And if you compare where the share price was in 2018, it was around about £2.40. It's now well below £1, and it's been as low as 63p. Now it's up today, around about 3.5%, trading in line with expectations. Another €500 million share buyback, so maybe there's an element of that in the price. But it's completed its merger with Three, and group revenue up 3.9% to €9.4 billion, and helped by a 5.3% rise in service revenue. So consolidation in this sector is certainly helping Vodafone, and certainly if you look at where its share price was 5 years ago, it looks cheap.
Yeah, absolutely. And the other thing with the Vodafone result that we had this morning was the German side of the business is still declining, but the pace of that decline appears to have slowed quite considerably, and that's obviously been the sort of problem child in terms of the company in recent years. So again, if as you say, they are trading at relatively low levels given where they've been in the past. So if this is the start of a prolonged and more sort of concrete turnaround, then there is going to be considerable upside there that you would expect. But again, how many times have we sat here and spoken about Vodafone and the prospect for things to finally be looking up, only for them to then disappoint about 6 or 8 weeks later? So I struggle to get too excited just yet.
Yeah, you say that, but I mean, I think it was a similar sort of story with Marks and Spencers. They went around a 15-year turnaround plan, and now look at where they are. They finally got that right. So maybe there's an element of that. You can say the same thing about BT Group. In 2017, their share price was around 500p. It's now just popped above 200p for the first time since June 2021. And that's on the back of what I would call a fairly average set of numbers, a 3% decline in first quarter revenue, EBITDA up 1%, and guidance unchanged. So perhaps here again, I think people are looking at these beaten down telecoms giants and thinking, well, maybe the worst is behind us. And certainly that's good news for the FTSE 100, given the fact that telecoms is a fairly big chunk of that particular index.
Yeah, absolutely. And one of the things that I think we and probably every other sort of City of London-based market participant has spoken about at length over the last number of years is how cheap the valuations are in the FTSE. And if we are starting to see that tide turning, then that could be an absolute boon for the index at large, because we are still. I think I saw a stat going around the other day that most stocks in the FTSE are probably trading at half the PE ratio of stocks in the Nasdaq, which gives you an idea of the potential for a multiple expansion.
Yeah, another stock doing well. Reckitt Benckiser upgraded its full year guidance after a decent performance in core sales growth. It now expects like sales growth of between 3 and 4%, up from 2 to 4%. So that share price is up nearly 10%. But it's still well below the levels it was in 2021, 2022, and 2023. So again, here, there's a perception that perhaps this big brand name, Reckitt Benckiser, Unilever, they make a huge range of products that you and I probably don't even realise they make. And finally, we do appear to be getting a breakout on some of these big multinational corporates that have underperformed for such a long time.
Yeah, absolutely, and again, you sort of go through the FTSE and some of the biggest London listed stocks, and there is a bit of a theme emerging of companies that are doing relatively well, that are certainly delivering on expectations, if not beating those expectations. They are being rewarded in the very, very short term, but then you zoom out on that chart and you go, well, actually, we are still many percent off the cycle highs or the record highs in those names in question. And you go, well, actually, if these companies can continue to deliver and the market does build up a little bit of a head of steam, then the longer run bull case is a solid one.
And I think one of the things we've forgotten about Reckitt Benckiser is they bought Mead Johnson back in the day, I think about 10 years ago, which was a big US multinational. And since then, they've had a severe dose of indigestion in trying to absorb that business. They now appear to be turning that business around. And I think we're starting to see the results of that in a rebound in the share price. Let's not forget that in 2024, the share price for Reckitt Benckiser was around about 4,084p. It's now up above 5,500. So, and it was back in the day up near 8,000. So there's quite a significant discount on that particular company. Certainly room for a significant recovery. Maybe not straight away, because these are impulse moves higher, and they may consolidate at these higher levels. But as long as they keep delivering on sales growth and keeping their margins under control, there's no reason to suppose these companies can't continue to push higher. And obviously that will then in turn help the FTSE 100.
Yeah, absolutely. And, fingers crossed that does indeed happen, because some outperformance and some decent upside in the FTSE 100 is a hell of a long time overdue.
Well overdue, particularly when you look back at 1999 and a lost 20 years. You could argue that it's well overdue, a significant catch up. So we're certainly halfway to 10,000. When I made the call, it was around about 8,100 for 9,000. Little did I know that we'd hit that target within 7 months. I think the bigger question now is there more juice in the tank? And you've really got to think, irrespective of how you believe the UK economy is going to do, a lot of these companies are in much better shape now than they were 2 or 3 years ago.
Absolutely. And then, of course, the other thing to consider on that front is, of course, that the vast majority of the FTSE earn the vast majority of their revenue overseas. So are not actually as exposed to fluctuations and shifts in the domestic UK economic backdrop as you may sort of think from a first glance. Yes, that is much more the case in the FTSE 250, which is obviously a lot more domestically focused. But in terms of the blue chip FTSE 100, that is a collection of names, and this is one of the reasons behind the exodus, of course, that actually earn the bulk of their revenue overseas. So one of the key drivers of performance has always been and will continue to be the value of the pound.
Yeah, but I also think that one of the good things that this move higher in the FTSE is doing is it's making these UK companies less cheap.
Yes, which will hopefully put off some of the potential predators that may have been lurking.
Indeed. Looking back at JD Witherspoon this week, your favourite pub chain.
I'm actually looking out the window at a JD Witherspoon at the moment.
5.1% increase in like-for-like sales in Q4 for the 12 weeks to the 20th of July. Sales volumes have recently overtaken pre-pandemic levels, with wines proving popular. I guess Rachel Reeves' budget would do that. And food sales have also recovered. And in a sign that even Witherspoon gets to do puns, chicken dish sales apparently put in a clucking good performance.
Tim Martin's a man after my own heart with that one, I think, when I saw that.
Yeah, that did make me chuckle that when I read that. Anyway, so we'll finish up with Lloyd's. Again, decent set of numbers. Set aside another £133 million in Q2 in respect of the Black Horse Finance. I don't really think that's going to be the issue that an awful lot of people thought it might be. I think now that they've set aside around about, set aside around about £2 billion in respect of that, and their profits were better, 1.41 billion in Q2, bringing first half profits up to £2.5 billion. So they could break £5 billion for the full fiscal year. I think one of the reasons I think they was a little bit disappointed was they didn't upgrade their guidance. Maybe that's an abundance of caution on their part because of concerns they have about the UK economy in the second half of the year. Your thoughts on that?
Yeah, I think I would agree with that, and I think it's a sort of prudent step for them to do. And actually, the last thing any company wants to do is end up over promising and then under delivering.
Mm,
There's really, I think perhaps the market might have been asking for a little bit too much if they wanted a guidance upgrade as well, given all of the trials and tribulations with UK PLC that we've discussed. But I agree with your initial comment there with regards to the Black Horse Finance and the whole motor finance issue. When that first broke, probably it must be getting on for about a year or so ago now, if not
mm,
longer. It did look like that could end up being quite punitive for Lloyd's and for a number of other UK banks. But I think they've probably, and I don't really want to tempt fate with this one, but I would imagine they've probably learnt their lesson from prior mis-selling scandals like PPI, where the costs end up spiraling and ballooning out of control, and actually gone, let's just put aside the capital now. And then if we don't need it, we can return that at a later date once the dust settles. So I think they're approaching this in a much, much better and a much, much more structured way than, well, certainly than I would have expected, but also than they would have done in the past. So I think that providing the UK economy can hold up relatively well, which is by no means a given,
mm.
then I think they are pretty well positioned at this moment in time.
Yeah, customer deposits were up, and obviously loan demand was up.
Hmm.
That'd be interesting to see whether or not that will get sustained into the third quarter, given the fact that obviously you would have seen a little bit of a surge in mortgage lending ahead of the April stamp duty threshold cut-off.
Yes, absolutely.
Okay, finish off with ITV. Their shares are up 12%. Again, decent set of first half numbers, trading ahead of expectations, despite a 3% decline in total revenue. But a large part of the reason for that decline was because of strong comparatives from a year ago when they got an advertising boost as a result of the men's Euros, which boosted the numbers somewhat. Obviously, they haven't seen a similar sort of uplift this year. But ITV Studios have done really well, with a 3% increase in revenue to 893 million. And ITVX is also performing well with a 12% increase in digital advertising. So they expect their full year results to come in ahead of forecasts. So it'd be interesting to see whether or not ITV can push above 90p, because that has pretty much capped the share price since December 2023.
Hmm. Yeah, absolutely. I think you've pretty much covered off everything there is there. There's really not a lot to complain about in terms of the results themselves. The question is, that level has been a very, very tough nut to crack. Can they now finally break above it? And if they do, then momentum favours further gains, clearly.
Yeah, they're certainly they've announced a further 15 million in cost savings as well. So it's going to be interesting to see whether or not they can sustain it. But I think one of the things that they do have in their favour is ITV Studios.
Hmm.
And as long as they can hang on to that and resist the temptation to spin it off, because there has been some chatter that they should do that, which strikes me as completely bonkers. You don't sell off your crown jewels.
Well,
Well, you just don't.
no, exactly. Certainly not at a time when it provides useful diversification for the remainder of the firm, and it is performing very, very well indeed. I think a sale would be an incredibly misplaced way of thinking at this point.
And one of the things that I think I've taken away, not only from ITV's results, but also was from Google's results, is that advertising is holding up.
Yeah, and I thought that was interesting because we spoke about WPP on our last
Yeah,
podcast,
we did.
who have obviously been struggling considerably, and I think most people, including myself, were saying, is that a barometer for the state of advertising more broadly? And it is remarkable how globally ad spend seems to be remaining resilient despite all of the economic uncertainty and various other headwinds that we continue to see. And again, sort of segueing into next week, that bodes relatively well for a company like Meta, who obviously rely considerably on ad revenue to fund the remainder of their operation.
Indeed, they do. And certainly, they're reporting their second quarter numbers. They did raise their capex forecasted Meta. So let's move on. It's a great segue, that, Michael. Let's move on to
Almost
Meta.
like we rehearse.
We did, yeah. Yeah. Oh, that's what happens, isn't it? So Google raised their capex forecast yesterday, last night, and Meta, at their last set of the numbers, raised their capex forecast for the year to between $64 billion and $72 billion. So it'll be interesting to see whether or not they do the same thing as Alphabet did last night when they report on the 30th
Hmm.
of July. On the outlook for Q2, they expect to see revenue between $42.5 billion and $45.5 billion. So it'll be interesting to see whether or not that comes in anywhere close, because it's certainly a big uplift from what we saw in Q1.
Yeah, very much so. And of course, Meta have been, arguably one of the most aggressive of the Mag 7 names in terms of their spending on AI. They've very much gone sort of all in on that theme. So it'll be firstly interesting whether they're going even more all in on that in terms of the capex front, as we alluded to earlier with Alphabet, but also when all of that will start to bear fruit. And I think that's what market participants are eventually going to question. It's all well and good this degree of capex flying around all over the place, and every quarter we raise the amount we're spending, but at some point the tough question needs to be asked of what's the return. And I think investors will increasingly look towards guidance that says actually the return is now coming through. In addition to, of course, as we started this segment, with a focus on advertising revenue and the broader macro read across from that.
Yeah. And talking of capex, Microsoft again spending heavily as well. $80 billion earmarked for the current fiscal year. At its last set of numbers, Q3 rather, we've got Q4 numbers on the same day as Meta. Will they raise their capex? I mean, we're talking huge sums of money here. 80 billion.
Yeah.
Microsoft.
Well,
85.
I was just going to say that, we're saying these numbers. I think we're all guilty of it. 80 billion here, 85 billion there, 70 billion here. This is a huge amount, an absolutely huge amount. But it's almost a case where every company is spending it, that it just becomes so normal, and you become so conditioned to going, that's all. That's just the ticket price. That's what the amount of investment that's now required. And again, you would sort of argue that if Alphabet are raising their capital expenditure, if Meta do the same, then Microsoft aren't going to be the ones who are left behind and keep their expectations unchanged.
It's like an arms race, isn't it?
But that's exactly what it is, and nobody wants to be the one who. Ultimately, no one really knows. I don't think where the whole AI theme is going to end up in a year's time, let alone 10 years time. But at the same time, no company wants to put themselves at a disadvantage right now by getting left behind by their competition. So I think that arms race is only going to continue, and again that will support the picks and shovels manufacturers, essentially things like Nvidia, Broadcom, TSMC, ASML, of course. The sort of follow through impact that it will have on the entire semiconductor supply chain is huge.
Well, Azure revenue guidance for Microsoft was increased to between 34 and 35%. They added cloud revenue in Q3 of $42.4 billion across various different areas. Now, Google added 30% in their most recent numbers last night. So if Microsoft can deliver 34 and 35%, then obviously that tends to suggest that there's still an awful lot of growth in the equation. And ultimately, the revenue guidance for Microsoft for Q4 is between $73.15 and $74.25 billion. So essentially, their data center capex is almost the equivalent to 1/4 of revenue.
It's crazy, isn't it? When you put it like that, when you put some context around the figures, we all sit here and go, they're very big numbers, but that's when you realize how big they actually are.
Yeah. So that's Microsoft and Meta. We've also got Amazon again, Amazon Web Services. Now their web services growth has actually been slightly lower. When we've seen Microsoft and we've seen Alphabet grow their cloud services by 30%, web services only saw revenues increase by 17%.
Which, to be clear, is still very, very good in terms of the pace of growth. It's just that expectations are now so lofty, given the figures that other firms are putting in, that you go, well, 17% doesn't sound like a lot.
But it's also a much smaller part of their overall business. So 17% is $29.3 billion. But the total revenues in Q1 were $155.7 billion, compared to $143 billion the year before. So again, we're banding about these numbers in billions. So capex of 80 billion is virtually half of what Amazon makes in a single quarter.
It's just crazy, isn't it? It is absolutely crazy the numbers that are being thrown around. But I think that is a really important point, and it's a similar point that we can make with regards to Apple in a moment.
Mm,
Is
yeah,
that they are more diversified operations because obviously Amazon has the AWS, the cloud side of the business, but they also have the retail side of the business essentially that we all interact with on a weekly or a monthly basis or whatever it may be. And the same can be said of Apple, of course. I'm sat here
mm.
with an iPhone in my hand, and so is probably everyone in the city at this point. They have more diversified revenue streams than some of their competition.
They do, but I mean, obviously, their key revenue earner for Apple is the iPhone.
Yes.
It still makes up the bulk of their overall revenue. So in Q2, the company posted revenue of $95.4 billion, which was an increase of 5%. But the iPhone only made up $46.84 billion of that.
Mm.
So less than half. iPad revenues, Mac revenues, wearables, services is continuing to grow as a share of income. It's now at $26.6 billion, which was an increase of 11% over the previous quarter a year before.
Mm.
So certainly I think in terms of Apple revenues, I think the key thing for me is where's the innovation coming from? Greater China region saw a decline in sales. Are they going to be able to offset that with growth in places like India?
Mm.
How are the supply chain disruptions going to affect the business? I mean, Tim Cook has already said that it's going to cost nearly $1 billion,
Yeah.
an extra $1 billion.
Yeah, I do think that, and I'm pretty sure we discussed this last quarter as well, but I do think there
Mm,
are an increasing number of question marks around Apple, and certainly the bull case around Apple. I think one is growth. China appears to be at best stalling. So, what replaces the growth that China has given Apple over the last 5 to 10 years? Is it India? Is it another
mm,
rapidly developing nation, or does that naturally just moderate and fade away? You've then got the issues with regards to the supply chain, and obviously chiefly the issue of tariffs on that front. The tariff rates and levies and countries that are being targeted seem to be changing multiple times a month at this point. So some clarity on that would be appreciated by everyone, I'm sure, and also the costs involved with Apple. Are they going to move manufacturing from China to India? Are they going to move it to Vietnam, or are they, in a potentially more extreme scenario, going to be forced to reshore that in the United States? And then the last point is your mention there of innovation. Obviously, the most recent new product that Apple launched was the Vision Pro headset, which I think everyone would agree fell pretty flat. No one even seems to talk about it anymore. The iPhone has probably been the same for processor improvements, camera improvements, screen improvements, etc. But it hasn't really moved on,
mm.
seismically for getting on for a decade, arguably. You can probably say similar about the iPad, about the Apple Watch, etc. Where is the innovation that's really going to help drive growth forwards? Because at the moment, it very much seems as if the Apple will keep ticking over because every 2 or 3 years people replace their products, they wear out.
Mm.
But there's not going to be like we saw, a decade ago when you've got queues around the block to get into an Apple store at midnight because they're launching a brand new product. That those days of really heady innovation seem to be behind us, sadly.
Yeah, I think that's probably why Apple has outperformed relative to all the other Magnificent Seven stocks. If
Mm.
you put Tesla to one side, it's probably underperformed the most.
Yeah.
Anyway, their numbers are due out on the 31st, along with Amazon, which sort of really ties a bow, I think, around the rest of the Magnificent Seven. And I think that gives us a good opportunity to finish off with some big UK numbers, which are due out
Mm.
next week. Let's start with Pascal Soriot and AstraZeneca
Yes.
first half numbers. Now, there's been an awful lot of chatter about whether or not AstraZeneca will be tempted to move to the US. Certainly, when the company reported in Q1, revenues increased 7%, and they do generate 42% of their revenues in the US.
Mm.
So it's not a discussion that's going to go away, is it, Michael?
No, it's absolutely not. And I think, as we mentioned when the whole sort of theme came up, well, it must have been about a month ago now when the reports initially started to circle that they may be looking to move their primary listing to New York. The issue is that it's not necessarily just a case of where are they getting their revenue from. It's not just a case of valuation. I certainly don't think they can have any complaints about the valuation of the firm. It's more, sorry, board rightly have a bone to pick around the operating environment here in the UK, politically and commercially. And that is obviously a much, much deeper issue and a much harder issue to be repaired and to resolve. And I think there's certainly going to be a lot of probing questions around that on the earnings call, because once that genie is out of the bottle, so to speak, I think it's going to be very hard, if not impossible, to get it back in there.
Yeah, I mean, it's not as if the UK government has made the company feel welcome. We've talked about this on previous podcasts. They
Mm.
reduced a 90 million pledge to 40 million pounds in respect of upgrading the Speak vaccine hub,
Yeah.
prompting the company to cancel the project. By contrast, this month, AstraZeneca said it was planning to invest $50 billion in the US by 2030.
Mm. Yeah, exactly. And when you put it like that, the government's decision looked ridiculous in isolation. It looks even more ridiculous now, to be
It's
completely
penny
honest with
pinching.
you. Yeah, for no gain whatsoever. Literally just penny pinching for the sake of it.
Mm. In terms of the UK consumer, I think it'd be very interesting to see what Next has to say for itself. They're publishing their second
Mm.
quarter numbers on the 31st of July. Now, we've talked about this before. Next always seems to raise its guidance and has done, I think, for the past 9 quarters. Will it be a 10th?
Well, this is obviously the all important question, but also this is where Next have potentially built a bit of a rod for their own back, because there is going to at some point come a time where they don't raise their guidance. It's whether it be this quarter, whether it be next quarter, whether it be in 3 years' time, whatever it may be. This run of constant beat and upgrade, beat and upgrade, beat and upgrade. At some point, logic would say that has to come to an end. Whether it's this time out or not, but when it does, you would imagine that the stock is going to take a pretty severe beating.
Well, the shares have sort of topped out. They topped out in May around about £13. They've drifted back to around about 12
Mm.
in the past couple of months. So it'll be interesting to see what management have to say about the overall retail outlook. They did say in their last update that there was an awful lot of brought forward
Mm.
purchases because of the warmer weather. Obviously, we've continued to have warm weather. Has that prompted some further purchases, or could there be a case for now saying that they're going to be a little bit more cautious about the rest of the year?
Yeah, and
So
and
that's an interesting one.
it is an interesting one, and as you say, the important thing there is purchases were pulled forward.
Mm.
It are crude example, but if someone's bought all their shorts and t-shirts that they want to wear during the summer in March because the weather's warm early, you're not going to go out and buy a whole new set of shorts and t-shirts because the weather's stayed warm. You're going to wear the ones you've already bought. So again, you're sort of moving revenue as opposed to necessarily generating more revenue.
So their sales guidance for Q2 was for 6.5%. So that's what we're looking for. And profits guidance was raised to $1.08 billion pounds,
Mm.
an increase of 14 million. So those are the two numbers that we're going to be paying particular attention to. The sales guidance, 6.5%. Did they meet that? And profit guidance, do they keep it at £1.08 billion?
Yeah, absolutely. And of course, the market will be again wanting to see an upgrade there.
Yeah, I don't think they're going to get that. Okay, we've also got Barclays and HSBC's latest Q2 numbers. I'm not really going to go into that because essentially both of those banks have got investment banking operations as well as retail operations. If JP Morgan's results are anything to go by, there shouldn't be any surprises for either of them, given the
No.
fact that Lloyd's were also fairly decent as well.
Yeah, and of course, it's not only US banks that have traded well or enjoyed a strong first quarter. We had earnings from Deutsche out this week, which were very, very strong as well. So you would expect that the spillover will be pretty positive for those two names too.
Indeed. Okay, we've got Rolls-Royce first half numbers due on the 31st. Again, those share prices made some significant gains over the course of the past few months. Been one of the best performers on the FTSE 100 so far year to date. Consolidating at the moment in and around the just below £10, record highs. Finally signed an agreement with the UK government for single modular reactors in June,
At long
with a
last.
view to signing contracts later this year for up to 470 megawatt reactors on sites which have yet to be designated. So of course, they signed an agreement, but the ink's, I would argue, the ink's still not dry yet.
Yeah, absolutely. And typical with UK planning and infrastructure, it could prove quite a long-winded process to actually find suitable and appropriate locations in which those can be built. But again, although the ink isn't quite dry on that one, it does seem like the company is frankly going from strength to strength.
Yeah, and the same can be said for BAE Systems, who are also reporting their first half numbers next week. Again, they signed a key contract earlier this year for £800 million with the US Air Force, and it's pushed the order book up to a record £77.8 billion. So again, another decent outperformer. Again, is it already in the price? I would argue that there's very little downside when it comes. Oh, no, those words will come back.
I was just going to say you're a very brave man saying that on a recorded line, mate.
Yeah, indeed. I mean, when you look at companies like BAE Systems and Rolls-Royce, with order books the size that they have, the only, I think, constraint that all these companies have is their ability to fulfill these orders.
Yeah, absolutely. And we've spoken about this before. The outlook for defence certainly remains very, very constructive indeed. The issue potentially is going to be, it's a nice problem to have, but do those order books get too big? Where the lead times become too protracted and actually the company can't fulfill the demand that is there. That's the risk or the bear case. But, frankly, things are looking pretty positive for BAE and the defence industry at large.
Which is why they need to build up capacity
Very quickly.
and spend an awful lot of money on capex. So in Q1, the company maintained its full-year guidance of a 7 to 9% increase in sales, which would push total revenue above £30 billion. So with an order book of £77.8 billion, they've got 2.5 years of work in the pipeline.
Yeah, and you would imagine that the order book is only going to increase as time goes on.
You would think so. So we're going to finish up with Shell. First half numbers. It's been a rather indifferent quarter. Obviously, lower oil prices have impacted profitability there. Capex budget between 20 and 22 billion. The rumours about a tie-up with BP won't go away, but to my mind, I still think that it remains a real stretch to even consider the idea that Shell is going to basically look at BP when it's got weakness in its chemicals division, which it still needs to get on top of, and it's got underperformance in its integrated gas business. So I think there's potential for disappointment in Shell's first half numbers when they're released next week.
Yeah, and I think that's also in terms of the M&A, we know there's going to be huge constraints around that if it does even get off the drawing board. But it's also a case of Shell will want to, and well, you would hope that they would want to sort their own house and get that in order before they start to go and look at other firms. So yeah, I agree with you. There is the potential for some disappointment on that front.
Okay, let's finish off with the Fed meeting and on-farm payrolls. Got anything to say on either of them?
Well, I can do this very quickly. The Fed will remain unchanged. Waller will vote for a 25 basis point cut. He may be joined by Bowman in that dissent, but certainly it won't be a consensus view on the committee, and they will just maintain their wait and see approach. Powell will not be drawn on all of this nonsense about him being sacked or resigning at the post-meeting press conference. And then in terms of non-farm payrolls, you would expect another resilient report. We had a solid pace of job creation and a much lower than expected unemployment rate in June. Between now and then, we've had jobless claims, both initial and continuing, have declined further, you would expect the labour market to remain in relatively resilient shape when we get those figures on Friday. And of course, the other thing with Friday is it is that potential tariff deadline in the United States if Trump indeed does follow through on the threats he made in those letters.
With respect to the EU-US trade deal.
Well, all trade deals, of course,
Yeah,
or those that haven't been made already.
Okay. Or it could just be a case of taco.
I think it will be a taco time again.
It's taco time. Well, on that note, feeling rather peckish, I think we'll wind up this week's podcast. And once again, apologies for the lack of video, but
Some may say it's an
unfortunately,
improvement if they're being
some
uncharitable.
may well say it's an improvement. But hopefully, once my spots clear up and I get rid of my beard, it'll be back to normal service.
Indeed.
All right. Thanks a lot, guys, and speak to you all same time, same place next week.
Bye for now.